Does this sound like your trading journey so far? You chase the highs, you buy the top, you panic at the lows, and rely on hope instead of strategy. But the successful 5% top traders, I'm not talking about the fake gurus with their fake Lamborghini on social media. I'm talking about those that really make a killing and a living off of trading. Those 5%, they do things differently. They see what you always miss in the market. But how do these top traders see what others don't? What do they know? What do they understand? What is their trading plan like? And how do they execute their trading plan that keeps them consistently profitable while everyone else struggles? Well, I spoke with 5 verified, highly profitable traders, people with decades of experience, traders who have weathered every market condition and still come out on top. And in this video, I'm revealing what they told me. I won't tell you what to do, but if you're serious about trading, pay close attention, because what you're about to learn will change everything for you. 1. They deeply understand risk and make it the foundation of their trading plan. In New York, in the late 1920s, when Wall Street felt invincible, when money flowed like champagne, when stocks soared beyond reason, and fortunes were made overnight, when everyone was getting in on the action, believing that the market will only go up and up, Jess Livermore successfully predicted the crash of Black Tuesday, October 29, 1929, and walked away with over $100 million, which till date is regarded as one of the greatest trading profits in history. To the vast majority of traders, Jess Livermore became one of history's greatest traders because he predicted the 1929 crash. But to the top 5% of traders, they know he succeeded because he understood risk. While the world was blinded by greed, he prepared for reality. When everyone was convinced stocks could never go down, he had already factored in the possibility of collapse. And when the market finally turned, it wasn't luck that made him $100 million. It was his ability to manage risk when others ignored it. This is the difference between the 95% who fail and the 5% who survive. And according to one of the traders I spoke to, if you are to truly make it as a trader, understanding what risk is about is a necessity. Most traders think understanding risk means using a stop loss or risking only a small percentage per trade. While these are important, true understanding and management of risk goes much deeper. It means fully accepting that anything can happen, accepting that no strategy is perfect, accepting that losing streaks are inevitable, and that the market doesn't care about your predictions. And here is the most important part of risk management. The moment you open a position, you have to let it ride out the storm, whether it is going in your favor or not. So I was told that to properly understand risk management and use it as the top 5% do, you have to 1. Know and accept losses as part of the game. When Livermore initially took his short positions, the market for months kept going up. He was in a losing position, but Livermore didn't panic. He already knew and expected that even the best trade setups don't work instantly. So instead of questioning his entire trading plan after a few losses, he trusted his risk management and let the probabilities play out. The traders who fail are the ones who react emotionally to every win and loss. But the traders who survive and thrive think in terms of probabilities, not individual trades. And that is confirmation that they fully accept that losses are a part of the game. 2. Focus on capital preservation over profit. Most of us chase gains, but the very best traders focus on protecting their capital first, because without capital, you can't trade at all. Livermore didn't go all in. Rather, he structured his trades so that even if the market kept rising, he wouldn't be wiped out. His risk was calculated. He understood that the goal isn't to be right every time. He understood that the goal is to stay in the game long enough for his edge to play out. 3. Control what you can and accept what you can't. No trader can control the market, but the successful 5% traders control how much they are willing to lose, how they respond to uncertainty, and how disciplined they remain. Understanding risk means accepting that you can do everything right and still lose. And that's not failure, it's trading. Livermore lost millions multiple times in his career, but he always managed to rebuild because he had a trading plan. Traders fail not because they lack knowledge, but because they refuse to truly accept risk. The market won't reward your predictions. It will only reward you when you are prepared for anything. And the moment you stop fearing risk and start managing it, you'll start trading like the 5%. Number 2. The 5% have full confidence in their trading strategy. Jesse Livermore didn't guess. He didn't trade based on gut feelings or follow the crowd. When he shorted the market in 1929, he did so with complete confidence in his strategy, even when the world thought he was wrong. The market kept rising. His trades were bleeding money, and even his closest friends laughed at him. Stocks will never go down again, they said. But Livermore didn't care. He understood that the market wasn't driven by logic, but by emotion, fear and greed at war with each other. He had seen this pattern before, and his system told him what was coming. He stayed patient. He executed his plan. And when the crash hit, he walked away with $100 million because he trusted his strategy when no one else did. At the time of making this video, I can say with certainty that the market is mostly choppy or in a downtrend depending on the asset you trade. And if you don't mind me asking, how many times have you considered trying something different? How often have you ditched your strategy to follow a new one you found online? You already know the answer. But here's what I was told about that, and I doubt will surprise you. Most traders think they have confidence in their strategy until a few losses hit, then doubt creeps in. They second-guess themselves, they tweak their system, abandon their setups, or worse, jump to a completely new strategy. They lack conviction, and that's why they fail. Having real confidence in your strategy means two things. One, you've tested it extensively, both historically and in live markets, and you trust the probabilities. Two, you've come to the understanding and acceptance that even the best strategy will have losing streaks, and you stick with it anyway. In a 2013 study on professional poker players who, like traders, rely on probabilities, Palamecki and his colleagues found that those who trusted their strategy, rather than react emotionally to short-term results, consistently outperformed their peers. The same applies to trading. The successful traders don't panic after a few losses. They build conviction through rigorous backtesting, knowing their win rate, drawdowns, and risk-to-reward ratio. They understand that trades lose, and instead of chasing individual wins, they focus on the rigorous execution of their trading plan, trusting that their edge will play out over time. So ask yourself, do you trust your strategy well enough not to abandon it, or will you let short-term noise shake your conviction? The successful 5% focus on high-risk-to-reward trades. Jesse Livermore didn't make $100 million in 1929 by taking random trades. He waited, he planned, and when the right opportunity came, he struck with full conviction. While others chased small, inconsistent gains, Livermore focused on high-risk-to-reward trades. The kind where one good trade could cover multiple small losses and still leave him with massive profits. That's how the 5% of traders who succeed operate. Most traders believe they need to win a high percentage of their trades to be profitable. But the top 5% know that win rate matters less than their risk-to-reward ratio. They don't take trades just because they look good. They wait for setups where the reward significantly outweighs the risk. Livermore's short in 1929 was the perfect example. He didn't short the market randomly. He waited for the bubble to inflate beyond reason, positioned himself carefully, and then executed when the risk-to-reward made sense. Even if he had been wrong several times before, the reward on this single trade far outweighed the risk, making every loss before it irrelevant. Another great example is the ongoing Bitcoin rally, where the widespread belief is that it will surge past $100,000. Traders who initially shorted around $100,000 likely placed their stop losses just above the all-time high to limit risk. When Bitcoin briefly pushed up to $110,000, they were stopped out. However, those who re-entered and shorted again before the crash would have seen huge rewards when the market eventually dropped. The 5% don't follow hype. They position themselves where the risk is low and the reward is massive. Research in behavioral finance shows that most people are risk-averse, meaning they would rather take smaller, safer profits than risk a larger but more uncertain gain. That's why most traders settle for low-risk trades with poor reward potential. However, avoiding risk as a trader isn't the key. Managing it correctly is. A study from the University of Chicago found that professional traders focus less on how often they win and more on how much they make when they win. That's why the 5% don't obsess over win rates, but focus on risk to reward. They know that a strategy with a 1 to 3 risk to reward ratio can be profitable even with a 30% win rate and 25% win rates to break even. Most traders focus on being right, but the top 5% focus on making more when they're right than they lose when they're wrong. I hope you understand that and let it sink. And when it comes to maximizing profits, this is where the next part of the plan becomes absolutely crucial. 4. They detach emotions from trading. Permit me to tell you a short story about you. You saw it. It was the perfect setup. You had spent hours analyzing the charts and waiting for the exact moment. Luckily, everything lined up. You entered the trade, and almost immediately, the price moved in your favor. This was it. Your plan was working. But then, doubt whispered in your ear. What if the market reverses? What if this small profit disappears in seconds? You hesitated, but it is better safe than sorry, right? So, you closed the trade early and locked in a tiny gain, telling yourself it was the smart move, controlled and disciplined. But minutes later, you checked the chart, and your stomach dropped. The price never reversed. It shot straight to your original target, exactly as you predicted. The trade that could have made your week. But you took very little. And then came the next trade. This time, you won't let the market trick you. So when it moved against you almost immediately, you didn't close it. It's just a pullback, you told yourself. It will recover. But no, it didn't. The small loss grew, and instead of cutting it, you held on. You adjusted your stop loss, giving it more room to breathe. It wasn't breathing, it was suffocating your account. Now you realized you should have taken the loss earlier. But now it's too painful to close. You have lost a large chunk of your trading capital. You stared at the screen, numb. The trade that should have been a huge win, you cut short out of fear. The trade that should have been a small loss, you let it spiral out of control. Fear, greed, hesitation. They played you like a puppet. As traders, the market is indifferent to your feelings. It doesn't care about your hopes, your fears, or how badly you want a trade to work. While the 95% let emotions dictate their decisions, chasing trades, hesitating out of fear, or revenge trading after a loss, the successful 5% remain emotionally detached. This is the core principle behind their success. They don't get euphoric after a win or devastated after a loss. They trade, like robots, not gamblers. We are wired to make irrational financial decisions under stress, and when money is on the line, our brain shifts into fight or flight mode, leading to impulsive choices rather than logical ones. And this is why most traders buy at the top because of the fear of missing out, sell at the bottom out of panic and fear of further losses, and overtrade to make back losses. But unlike most traders, top traders don't let emotions control them. And if you're wondering how they do it, here's what I have learned from them. 1. They don't react, they execute. Every trade of the top traders follow a structured trading plan, playing in the knowledge that over time, their edge will play out. 2. Losses don't shake them. They accept risk as part of the game and move on without hesitation. 3. They trade with logic, not ego. No trade chasing, no over-leveraging, no doubling down on losses. And 4. They cut losses early without hesitation. They exit and wait for the next high-probability setup. While others panic, they stay disciplined, and that's why they win. The difference between the 95% who fail and the 5% who succeed isn't luck. It's having a trading plan and the discipline to follow it. The market rewards structure, patience, and execution. And if you don't have a solid trading plan like the top guys, you're not trading, you're gambling. I have no doubt this video has sharpened your edge and given you more firepower for your trading journey. But if you want more, why not check out this recommended video? It is packed, and you will be doing yourself a world of good by watching it now. If you don't know already, I created a Telegram channel for more in-depth trading psychology discussion. Things I can't really do on YouTube. Plus, I share my personal market views and trades there. It's also a place to chat with other traders, including me, and we can all learn from each other. Link is in the description. Please don't forget to like, subscribe, and most importantly, comment if you have found this video helpful. Thanks for watching, and until next time, may the trend be with you.